Hey, how's it going, guys? Welcome back to the second part of the best high growth stocks in each sector. In this series, we deep dive into all the 11 different sectors in the US equity market and find the best high growth investment ideas in each sector for you guys. If you haven't watched the first part yet, you can check it out after you watch this one. I will leave the link in the description below. Alright, let's get started. Healthcare is certainly one of the best performing sectors in 2020. And among all the companies in the healthcare sector, Dexcom is definitely the fastest growing company by far, and their stock is one of the hottest high growth stocks on Wall Street this year. Analysts view Dexcom as the perfect play in the new booming telehealth industry due to the COVID-19 pandemic. Dexcom makes the blood monitoring devices for diabetes patients, and they're expected to get a massive increase in sales because after the COVID-19, more and more patients prefer remote monitoring, avoiding hospitals and clinics as much as possible. Government and regulators are also removing some major restrictions on telehealth companies, showing much more willingness to support them for the long term. And that's exactly why we're seeing such a massive growth potential on Dexcom. Forward revenue growth rate is at 30.7%. Forward earning growth rate is 102%. Free cash flow grows at 80.9% year over year. And thanks to the global lockdown, the company's EPS in 2020 is expected to increase by a mind-blowing 121%, beating the entire healthcare sector by over 1,300%. Dexcom's long-term growth potential looks pretty solid. Analysts expect them to be able to grow 33.6% every year over the next 5 years, leading the whole sector by over 200%. But there's only one major concern I have when it comes to Dexcom is that the stock is currently traded at a crazy 174 times of its 2020 estimated earnings. And that is an insanely high valuation with a lot of future growth has already been priced in. It is completely normal to pay a certain premium for a high growth company. If the PE drops back to around the 80 to 90 territory, I'm definitely comfortable to start adding positions on Dexcom. Industrial sector is probably the slowest growing sector with the most mixed stock performances, especially during this COVID crisis. Although industrial is not a sector that's particularly favored by the Wall Street, we still have one high growth company in this sector that deserves to be in our portfolio, and that is Fastenal, stock ticker FAST. Fastenal is one of the largest global distributors for personal protective equipment, delivery packaging, and storage facilities, which will continue growing after the COVID-19 pandemic. Analysts expect their forward earnings to grow at 11% year over year and the long-term EPS growth rate of averagely 13% per year over the next 5 years. But the major highlight of Fastenal's performance is their extremely strong cash flow and their solid dividend growth. Their forward free cash flow is expected to grow at 45% per year. Currently, they are paying a 2.2% dividend yield, and with such a strong cash flow growth outlook, they're expected to grow their dividend payment at a stable 13.2% per year, beating the sector average by almost 250%. Fastenal is definitely a solid play if you're looking for the high growth balance between dividend and the capital gain. Due to the recession that caused by the global lockdown, plus the zero interest rate and extremely dovish Federal Reserve, the financial sector is one of those sectors that are hit the hardest. But thanks to the $4 trillion helicopter money that is injected into the market, the trading volume has actually hit a historical high, and that actually makes some trading brokerage company in the financial sector achieve pretty solid growth. And among all of them, market access, the stock ticker MKTX, is the biggest winner. Forward revenue growth is estimated at 32.6%, forward earning growth 40.6%, free cash flow 23.7%, and the long-term EPS is expected to grow at 20.1% year over year over the next 5 years. As a high-growth company, Market Access also surprisingly pays a 0.5% dividend yield with a forward dividend growth rate at 18.2%. Market Access is a leading electronic trading platform for fixed income securities, which is a much larger market than the equity market. Backed by the several Wall Street hedge funds, their stock price is only slightly overvalued, currently trading at a 61 price-to-earnings ratio. But the demand for the fixed income product over the next 5 years will be expanding at a faster pace with the growth of exchange-traded funds and other institutional fund buyers. And that certainly justifies the premium that the market currently is pricing in over Market Access share price. Consumer staples is the sector that is always in demand regardless of a recession or not. The companies in this sector usually sell essential products that have extremely low margin, so that makes it very challenging for consumer staple companies to achieve a high growth rate like other sectors. But we can still find some solid companies with high growth track records, and among all of them, Monster Beverage, stock ticker MNST, is ranked the #1 company with the highest long-term estimated growth rate in the entire sector. Forward revenue is expected to grow 10.9% year-over-year, forward earning growth at 9.8%, and the forward cash flow growth at 9.1%. Although they don't look as high as other sectors, this is considered pretty impressive for a low-margin consumer goods business. And we can see that they're completely dominating the entire consumer staple sector, beating other companies by over 300%. Analysts gave Monster Beverage a very solid 5-year EPS long-term growth outlook. They expect the company's EPS will be able to grow averagely 13.6% per year over the coming 5 years. Well, if you have been following the consumer staple sector long enough, you will know that the Monster Beverage has been always one of the strongest performers for years based on their stable growth rate. They also consistently beat S&P 500 index by over 8% every year. If you don't have any stocks from consumer staple sector and are looking for some stocks to diversify your portfolio, then Monster Beverage is definitely your best choice. Technology has always been the fastest growing sector. The whole new socially distanced world after COVID and this new normal of working from home are making tech stocks even more attractive to the investors. Being extremely competitive among all the high growth tech stocks, ServiceNow, stock ticker NOW, stands out in 2020 and ranked the #1 high growth company in the tech sector. ServiceNow is an enterprise subscription-based software company providing corporate workflow and a cloud computing platform, which is in huge demand in pretty much every single industry. 2019 was the first year ServiceNow achieved a positive earning. From 2019 to 2020, they were able to grow their earnings by another mind-blowing 200%. And on top of that, analysts estimate ServiceNow's annual earning growth rate should be maintained at 36.6%, which is extremely high. Forward free cash flow is expected to grow 40.8%, and the long-term EPS growth rate over the next 5 years is estimated at 32.8%. ServiceNow's PE ratio has reflected their full growth expectation. Currently, their stock is traded at a 103 times estimated 2020 annual earnings and a 72 times 2021 earnings. But their stock price has gained a crazy 47 annual growth over the past 5 years despite such a high PE and valuation. The reason? Pretty straightforward. ServiceNow has one of the best track records of beating Wall Street's estimates. Since their IPO back in 2016, they surprised Wall Street analysts 15 out of 16 times, becoming one of the hottest tech stocks among institutional investors. Although the short-term upside for ServiceNow is pretty limited, their long-term growth still remains extremely bullish. If the technology sector is the biggest gainer in this COVID recession, then the energy sector is definitely the biggest loser among all the 11 sectors. Oversupply of the crude oil plus the massive crash on global demand created a perfect storm for energy stocks disaster, especially those oil and gas stocks. But if we look into the whole energy sector closely, we can find out that not every energy stock is a loser in 2020. In fact, there are some companies actually benefiting from the lower oil price. Out of the 25 companies in the S&P energy sector, Cabot, stock ticker COG, is the only one with a positive year-to-date return, gaining over 20% including dividends, and is also ranked the #1 in the energy sector, with the highest growth potential over the next 5 years. Although their revenue and earnings outlook were badly hurt in the recession, the company's other growth metrics are extremely impressive. In fact, it's even more impressive than those high-flying tech stocks. Analysts estimated that over the next 5 years, the company's long-term annual EPS growth rate will be maintained at an insanely high level of 55% with 17.5% free cash flow growth rate. They also pay a 2.2% dividend yield with a 34.5% annual dividend growth rate. Among all the top stocks in each one of the 11 different sectors, Cabot actually has the highest EPS growth potential and the highest dividend growth rate. Also, currently their stock is traded at 32 times of 2020 earnings. That shows a lot of their future growth potential hasn't actually been fully priced in yet. So if you are looking for high growth energy stocks to play the value game, COG is definitely the perfect balance between value, dividend, and growth. Alright, we have finally covered all the 11 sectors and the best high growth company in each sector in 2020. Hope you guys enjoyed these 2 videos and find some valuable investment ideas for your high growth equity portfolio. Of course, you can always let me know which company or sector you would like me to cover in the future. I will do my best to cover them in my future videos and share with you my analysis. Cool, that will be the end of this video. If you are new to the channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas and what investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and business and find my videos been valuable to you, please consider subscribing. Thanks so much for watching, guys, and I'll see you guys soon.